Welcome to TheoTrade. This is Don Kaufman. Here we are. It's January 6, 2018, doing the Theo weekend update. Wow, where to begin? One of the most astounding kind of short 4-day weeks that I have seen in 20 plus years of trading. The S&Ps, along with the heavyweight market caps, explode to the upside. But as we're going to see here in a few moments, and I'm going to dig into this a bit, it's not every underlying participating in this rally. In fact, far from it. As I mentioned a moment ago, this is about heavyweight market caps pushing index products into ultimately the stratosphere. There's another point that I want to make right up front, and that deals a lot with what I look at as much more of a quantitative trader, and it deals with efficiency of the marketplace. So let's go back and just recap some of the move that we saw. And I'm not saying let's recap the rally over here. No, let's recap from kind of a statistical standpoint how large of a move that we just saw. And to do so, I'm going to go over here to the Analyze tab on thinkorswim, and I am pulling up data from ultimately the previous week. If you want to take a quick glance and kind of follow along over here with me, I'm pulling up data from the previous Friday's close. So it was, before the new year. I went right to a Saturday, which was December 30th, 2017. And first of all, I wanted to show you the expected move for the week. We were expected to move just shy of about $30. We'll call it a $30 move. What was the actual move on the week? So towards the end of the year, we end pretty much at 26.73 and change. Where do we end, Friday, yesterday? 27.43. Not going to take a lot of math to figure out that's a 70 handle or 70 point move when the expected was ultimately 30. How does that, kind of quantify and compare to any of the recent breaches of expected move? And the answer is there's nothing to compare to this until you go all the way back into the week of like December 7th from 2016. So we have had well over a year, and I'll show you, because again, I've been tracking these expected moves now literally for years, and you're looking at one of the largest breaches of expected move. And what was interesting about this breach is it's not just in the SPX. What you saw over in the Nasdaq was equally as astounding. I mean, this is the Nasdaq kind of breaching. I mean, look at this. The Nasdaq ending at 155 and change, all right, into the new year, and ultimately closing at, 162. There's another way to kind of put this into context. I'm going to show you this, and it's kind of something fun I've already been doing. Take off the expected moves. Look at the year-to-date percentage. Now, granted, here we are. We're only talking about 4 trading days. I don't think enough people are doing this. They're not looking at this on percentage terms. We're only looking at 4%, or 4 trading days, and we're already looking at percentage terms year to date. That's a 2% move up in the Nasdaq. If you want to look at the S&Ps, it's just shy of a 2% move. But what I want to get to with this is it's not so much, again, about, the percentage move. I just thought that was kind of wild numbers. When you're looking, you're like, yeah, so I'm 4 trading days into the year and I'm already up, 2% in the major indices. Just wait. We'll show some individual underlyings here in a moment. This is a sign, if you will. And some people talk about markets, they go through different stages, and they try to quantify it's the fear of missing out, the FOMO, or this is, a blow-off stage. What I try to do is I don't want to label the move that we're seeing in the last 4 days in terms of classical economics over here, the fear of missing out, or, the final ascent. Final ascent would be, in kind of a bubble phase over here. But what I can quantify is this in terms of standard deviation. again, if you're looking at this in terms of standard deviation and how large the move has been, again, we're supposed to be expecting in this range plus 30, all right? Plus 30 over here, and all of a sudden we end up plus 70. The only way to really do this is, well, you know, if you move two deviations would be about a $60 move. And you're in territory here that is literally, all right, beyond, slightly beyond 2 sigmas or 2 standard deviations outside over there. And when you start looking at this, again, from a statistical standpoint, how astounding a move like this happens to be, okay, this, you know, being a distribution curve, not a very good one, but a distribution curve. Let's say, you know, in terms of occurrences, 68% of occurrences are here. Then you go out to 2 deviations that, you know, accounts for like 95% of all occurrences. Then you go all the way to 3 deviations. Well, in this move that we saw this week, we're somewhere right in this neighborhood out here, which is kind of between like 2 and 3 deviations. But again, to quantify that, it's almost like just an insane move. And again, I'm not telling you anything you don't know in here, but the point of this is it's moving a marketplace that has been incredibly efficient. You know, we looked back earlier this week, we looked back at 30 of the most recent expected moves. And if you looked back at 30 of the most recent expected moves, 6, okay, out of the 30 most recent weeks had a breach of expected move. Okay, so for the most part, what do you get? 80% of the time, we've actually been inside the 1 deviation, which is actually kind of a statistical, you know, aberration unto itself. Instead of moving 68% of the time, lately, we've been moving 80% of the time in a 1 deviation move. And all of a sudden, we get this just wild and woolly breach to the upside. It's a marketplace that literally gets like pent up aggression from the fact that, you know, the statistics are just starting to break down. That, to me, is a sign. It's a definitive change. I don't know at this point, nor does anybody. Is that it? Is this going to be the top? Is this, you know, the big sign that everybody's looking for? I will be able to quantify that, okay, as we move forward. But it absolutely, statistically, again, reeks of a marketplace inefficiency. I mean, what this basically means is you could have gone out and bought a straddle and exploded. Like the straddle would have cost you, you know, in the neighborhood of like $25. And that thing is worth $70 by week end. That is an inefficient marketplace. And again, a sign and a stark contrast to anything that we've seen in this recent rally. And you can go back through all of 2017. You haven't seen anything like this. So when people are talking about, oh, it's much of the same from 2017, okay, I strongly disagree. We did not see any rally like this. This is completely change of the narrative over here. In addition to it, one thing that I want to point out, you know, on this front, and by the way, moving forward, okay, the volatility contracted substantially. So in the previous week, we had 4 trading days, and we had a $30 expected move. Okay, this coming week, which we're coming into a full trading week now, 5 days, we're back down to a $22 expected move. So all of a sudden, we go from one extreme, and then we just contract volatility back down to a $22 expected move. So, you know, again, moving forward, the marketplace is saying like, all right, we had a big blow off over here, and now we're going to go back into an extraordinarily tight range. Okay, I'll kind of reiterate the stance. After seeing such a wild move, I want to be on the buy side of options this next week. Why do I want to be on the buy side of options? You just saw a 70-point move in the S&Ps in 4 days. Okay, maybe there's some follow through to the upside. But there's also the chance the markets could possibly reverse. Things are going to get wild. But to think that we're going to be inside of a $22 expected move is that's something that, again, I just don't think is going to be possible, having seen a move that's, you know, upwards of almost 3 times that. So again, $22 expected move. I am a net buyer of premium in the coming week. Now, I'll digress here for just a moment, because one of the things that really stands out to me this past 4 trading days is, more than any point in the previous year, this move has been a move about large market capitalization. Okay, if you follow with me over here, I use this market watch, and there's a feature I use all the time, and it's called the advanced decline line over here. It's called index watch. I'll just kind of take you through it. I use this feature all the time to get a feel, for instance, of not only the advanced decline line in the S&P 100, but literally as you drag your mouse across the screen, you can see what's up and what's down on a given day. And one of the things that really stands out to me is this has been a rally this last 4 days of not just the usual suspects, it's only these mega market caps. Now, I'm sure somebody can point out, well, no, this small stock rallied. Yeah, but it's the mega market caps that are moving the indices. And what I'm seeing is, if you have a portfolio right now and your portfolio is even well diversified, have you noticed your portfolio is not performing nearly as well as the marketplace? Okay. If you had a portfolio that was just, for instance, you purchased the spiders, okay, you're getting, market performance of the spiders. But the only stocks that are really driving, okay, products like the spiders, the S&P's higher, are, again, they're the mega market caps. And I say mega market caps, I start looking at things like Boeing. Okay, we'll go to the Googles, we'll go to the Facebooks over here. But as you start to take a look around, and again, I'm going to take you to a number of underlyings over here, it's pretty shocking. Just pick just a large number of underlyings that you can think of and start looking at those. And I'll start with something like as easy as the financials. Now, we all realize the financials, one of the largest market caps out there, did they participate, okay, in this kind of wild rally? Yes, but to a much lesser degree. Even when you start to look at stocks like Goldman Sachs, Goldman Sachs didn't fare well on the week. All right. And I started looking through here, and I looked at even underlyings like a Costco. Costco, by the way, this is something we'll talk about a lot in this coming week. This thing had stellar numbers that came out of Costco. And I wanted to use this as kind of a marquee product, but Costco had stellar numbers that came out for same store sales. Okay. Look back at it. Seriously, do your own homework. Same store sales smoked it from the previous month, and the stock ultimately fell. Could be kind of a key reversal in here. This is something I might look to enter into a longer duration short position on. But I want to show you, this is something that helped lead portions of the rally over here. Then we look at something like Walmart. It's a trickle to the upside. Again, this is big market cap stuff over here that is not producing the returns. But then as you start to look down some of the usual suspects, okay, what really rallied? Look at Caterpillar, okay? Right here, this is one of your kind of mega market caps that's been pushing markets. Take a look at this, ExxonMobil. ExxonMobil hasn't done anything. And I said that the narrative is and has changed. ExxonMobil didn't do anything last year. I mean, look back even, you want to get, let's get crazy. Let's go back over here to like 3 years. This thing is ultimately over 3 years, it's still down. And all of a sudden, mega market cap comes alive. And I call it like the mega market cap over there. These are just underlyings that are in the 100 billion plus kind of category. And ExxonMobil for years was the largest market cap out there before Apple ultimately eclipsed it. Okay. The Caterpillars out there, this was not a mega market cap, but a little perspective over here. Okay. Caterpillar has become just that. And again, I can't stress enough when you start looking at stuff like this, and the market cap, by the way, of Caterpillar is just right around $100 billion. I said this is the $100 billion club. But when you start to look at charts over the last 3 years, and then you start to look at, well, have some fun over here, year-to-date percentage, this thing's up 3%. Okay, so I started continuing to look over here. Looked at products like Intel, which is, okay, big, heavy market cap. All right, it actually fell. Huge news this week. Anyway, started going through more and more market cap over here. Bank of America, for example, did it rally this week? Yes, mildly so. Most of the banking stocks did not participate kind of in this rally. We are left, and you have to recognize this. We are left, people with handfuls of underlyings now that have capacity to move an entire marketplace. So whatever you want to say about the rally, and that's the point that I'm trying to make over here. By the way, Netflix is for the most part one of the largest percentage gainers on the week. It's up almost 5% year to date. But the point that I'm trying to make with this, all right, and again, we've had mega market caps that have been moving markets in 2017, but now we're left with, you can literally count them pretty much on both hands of how many underlyings were really driving this week's rally. You're seeing astounding percentage moves in these mega market caps, okay? And that constitutes the move in the Nasdaq, constitute the move inside of the S&Ps, not broad-based markets driving much higher. And again, think what you will about the S&Ps and think what you will about the expected moves in efficiency and inefficiency. The risks out there of handfuls of underlyings driving markets higher, okay, is unbearable at this point to even watch. And I think that at some point you have to step back from, markets on a day-to-day basis, even as a trader. Okay, listen, I'm a trader, been a trader for like over 20 years. And, I try to step back from looking at markets on a day-to-day basis. And I start to open up like, larger, broader time frames if you want to look at, technicals and so forth. But one of the things that stands out, it's not just the ascent over here. It's that, again, what you're seeing. Okay, first of all, everybody's like, well, this time's a little bit different. Yeah, this time's different. This time is far more risk than we've ever seen before. Since I've traded, talking to other traders, this is far more risk. You have, again, handfuls of underlyings that are propping up entire indices. And what you're looking at right now, if you believe that quantitative easing has pushed us there, okay, and to these levels, and this is not about being long or being short. This is realizing that the unwinding, okay, of any type of quantitative easing is going to take years and will take tolls on the marketplace for years. And it's, I'm not even going to get into risk reward over here. The fact of the matter is, we appear at this point in time, okay, and to kind of give you a little summation of this, we appear at this point of time to be moving back into what I would term, okay, from like the investors market, where it's, nothing but blue skies and large percentage returns to the upside. We appear to be moving much more into the traders market. And that is ultimately going to be, okay, trading in and around, for instance, volatility. It's been a long time, people, since we've seen inefficiency in a marketplace. Inefficiency like this breeds massive opportunity. As I said, I'm a net buyer of option premium this next week. That's the kind of stuff we got to focus on. We don't know at this point in time, nor does anybody, when markets finally break. That is what you have to be determining for yourself as an investor or a trader. And I know that everybody sits here and they go, yeah, weekend update over here. I want to know when this thing is going to break down. Okay, markets are going to snap, and it will be shock and it will be awe. Okay. The point, though, I'm going to make with the markets snapping, when they eventually do snap, you need, okay, as an investor, to step back and assume, okay, that buy the dip will not work anymore. And again, that's really hard to describe to somebody that's watched since 2009. The markets just continue to vault to new highs, and that every dip you would have bought, okay, I fear. And it literally, people are like, what keeps you up at night? I'll tell you exactly what keeps you up at night. I've seen this movie before. And when we finally do snap, and you're going to try to buy into it because you've already missed out possibly on some of the upside, people are going to be trying to buy into this for years. Okay? You have a marketplace that could turn into a bottomless pit. All right? Well, you're getting a marketplace that's moving to the upside at the same kind of statistical levels that we've seen in down moves. Now think about that. They always say the market moves down about 4 times as fast as it moves up. Okay? Well, I go back and I ran some stats on it. And guess what? Right now, we're moving up at a rate okay, of how quickly we've moved down in some of the most wild bearish markets out there. And the assumption, at least from my standpoint, is when markets finally do cease, rallying over here, first of all, it ends with a bang. It will probably be quite violent. After that, people will turn around and they will try to buy dips for years, likely giving back profitability that they've accrued since 2016, 2017, and really the last legs of this up move. Okay, it's becoming, and most definitely to me, is the trader's market. We are going to take, short directional bias positions from time to time. When I say short, I'm talking about time frame in here. We're going to get long, we're going to get short. Okay, we're going to look for opportunities to buy options when we appreciate the fact that the marketplace is inefficient in terms of the fact that it exploded through the expected move. We're going to get back and we're going to look for some small premium opportunities in here as time moves on. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.